So let's talk about what happens if oil hits $150 a barrel. You might think a shock like that would hit everyone the same, but it won't, not even close. Europe and Asia are on track for two completely different outcomes. We're going to break down why this one price point could trigger a massive, and I mean massive, redistribution of economic pressure across the entire globe.
Yeah, $150. Now you might think, okay, it's just a number, but it's so much more than that. You have to think of it as a catalyst. A price this high would set off a profoundly uneven economic event, sending a powerful chain reaction through the world's economies.
And it really is a tale of two continents. On one side, you have Europe, which faces a very direct, very clear threat because of its incredibly high dependency on energy imports. And on the other side, you've got Asia, which presents a much more complex picture, with some clear winners and some definite losers emerging from all the chaos.
Okay, let's start with Europe, which would absolutely be the epicenter of this shock. We need to dig into how exactly a price spike like this would ripple through its economy. What are the transmission mechanisms here?
So what's at the heart of Europe's problem? Well, it all comes down to its energy dependency. I mean, the continent's industrial economies are just so deeply reliant on imported oil and gas. This basically creates a direct pipeline for an external price shock to hit home hard and fast.
And because of that dependency, the effect on inflation is, well, it's both direct and severe. Higher energy prices aren't some abstract problem. They immediately, and I mean immediately, translate into higher costs for factories, for shipping, and ultimately, for you and me, the consumers, on everything from our food to our electronics.
The projected impact is just dramatic. You can see it right here. The jump from current inflation to where things would be with $150 oil isn't just a minor uptick. It is a full-blown surge that would put immense pressure on both households and businesses all across the continent.
So, what do you do if you're the European Central Bank? This creates a massive policy dilemma. I mean, do you raise interest rates like crazy to fight this runaway inflation, which could easily tip the whole economy into recession? Or do you try to support growth and just risk letting inflation get completely out of control? There is no easy choice here. They're stuck between a rock and a hard place.
All right, so that's Europe. Now, let's shift gears and head over to Asia, because this is where the story gets really different. The impact here is not uniform at all. It's a region defined by these starkly contrasting vulnerabilities and some unique strengths, which leads to a highly differentiated response.
You know, to really get what's happening here, you have to break the region down. You just can't talk about Asia as this one single thing. The experience of an energy importer like Japan is going to be wildly different from an oil-exporting nation in the Middle East, for example.
So let's take a look at the big industrial powerhouses, right? For China, the world's factory, this would mean intense manufacturing margin compression. That squeeze on profits could disrupt global supply chains for literally everything from iPhones to furniture. And then there's Japan, one of the world's largest net importers of energy. They have an extreme sensitivity to these price swings that would just ripple through their entire economy.
And then you've got this incredible contrast. On one hand, a country like India is super vulnerable to imported inflation, a major threat to its economic stability. But on the complete opposite end of the spectrum, oil-exporting nations in Asia, they stand to see a massive revenue boom. It's a perfect example of how this one shock creates both immense pain and huge profit all within the same continent. Now, a shock this big, it's never going to stay regional. It inevitably sends these powerful ripple effects across the entire global financial system, impacting everything from currency values to international capital flows. So, how does this shockwave actually travel? Well, it tends to unfold in a few clear steps. First, the oil price spikes. Right away, that shifts trade balances. Importers are paying way more, exporters are earning way more. The uncertainty from all this drives a flight to safety, which strengthens the US dollar, and that, in turn, puts severe stress on emerging markets. So why is a strong dollar so problematic? Well, it's because it creates this vicious feedback loop of financial pressure. See, many emerging market governments and corporations borrow in US dollars. So when the dollar strengthens, the real cost of paying back that debt suddenly explodes, straining their finances to the breaking point. And all that financial pressure we just talked about, it often leads to something we call capital outflows. This is basically the large-scale exit of money and assets from a country. Global investors get nervous, they pull their money out, looking for safer places, and that just further weakens the local economy. All right, so we've talked big picture. Let's bring this down to the market level. For investors, this kind of shock creates a really clear divide between sectors. You get some obvious winners and some very obvious losers. As you'd probably guess, industrial sectors would be under a ton of pressure.
European equities, sitting right there at the epicenter, would face the biggest risk of a sharp drop. Asian industrials would also feel the heat, though maybe not quite as severely.
But here is the stark contrast. While the broader global equity index would likely be in the red, the energy sector itself would see powerful outperformance. The same force creating all that pain for industrial companies is creating a profit windfall for energy producers.
So at the end of the day, for anyone watching the markets, the main takeaway isn't just about stocks going down. It's about a sharp and sustained rise in volatility. Uncertainty just becomes the new normal, which makes any kind of strategic decision incredibly difficult. When you boil it all down, it comes back to this one core idea. An oil shock is never a uniform event. It acts as a great redistributor, shifting economic pressure and financial opportunity from one part of the world to another. And that really leaves us with the final critical question to think about. As these global economic plates shift right under our feet, where will all of that pressure and all of that opportunity be redistributed next?